In the previous episode, we explored the financial framework investors use to build long-term wealth. But a framework alone doesn't make money. It's what you put inside the framework that determines whether your wealth grows or stagnates. And that brings us to one of the most important concepts in investing: asset classes. Professional investors don't build portfolios randomly. They divide capital across specific categories of assets that behave differently in different economic environments. Today, we're going to break down the core asset classes investors use to build resilient portfolios and why understanding them is the foundation of systemic wealth. An asset class is simply a category of investments that share similar characteristics. Assets within the same class tend to behave similarly in markets. For example, most stocks react similarly to economic growth. Most bonds react similarly to interest rate changes. This is important because different asset classes perform well at different times. When one struggles, another may outperform. That's why professional investors don't rely on a single asset. They rely on diversification across asset classes. Understanding these categories is the first step toward building a portfolio designed to survive multiple economic cycles. The first and most widely known asset class is equities, also known as stocks. When you buy a stock, you're buying ownership in a company. Stocks represent claims on corporate earnings and growth. Over long periods, equities have historically produced some of the highest returns among major asset classes, but they also come with volatility. Prices fluctuate daily based on economic data, investor expectations, and corporate performance. For long-term investors, equities often serve as the primary engine of portfolio growth, but relying entirely on stocks can expose a portfolio to significant risk during market downturns, which is why investors combine them with other asset classes. The second major asset class is bonds, also known as fixed income investments. When you buy a bond, you're essentially lending money to a government or corporation. In return, the issuer pays you interest and eventually repays the principal. Compared to stocks, bonds are typically considered lower risk but lower return investments. Their primary role in a portfolio is stability and income. During periods when stock markets decline, bonds often help reduce portfolio volatility. That's why many traditional portfolios combine equities and bonds. Together, they create a balance between growth and stability. Another major asset class is real estate. This includes residential property, commercial buildings, and real estate investment trusts, also known as REITs. Real estate offers two main sources of return. First, income from rent or leasing. Second, long-term property appreciation. Real estate also behaves differently from stocks and bonds, which makes it valuable for diversification. In some economic environments, property values rise even when other markets slow down. Because of this, many long-term investors allocate part of their portfolios to real estate exposure. Commodities represent another important asset class. These include raw materials such as gold, oil, natural gas, and agricultural products. Unlike stocks or bonds, commodities are physical resources. Their prices are heavily influenced by global supply and demand. For example, energy prices often rise during periods of strong economic activity. Gold, on the other hand, is often viewed as a store of value during uncertainty. Because commodities react differently to economic conditions, they can help hedge certain risks within a portfolio. Cash might seem like the simplest asset class, but it plays a critical role in portfolio management. Cash and cash equivalents include savings accounts, treasury bills, and money market funds. These assets typically generate very low returns, but they provide something extremely valuable: liquidity. Cash allows investors to respond to opportunities quickly and manage short-term financial needs. It also acts as a buffer during market volatility. Even the most sophisticated investors maintain some allocation to cash. Beyond traditional categories, investors also use alternative assets. These include private equity, hedge funds, venture capital, and collectibles. Alternative investments often aim to generate returns that are less correlated with traditional markets. In other words, they may perform differently than stocks and bonds. However, these assets are often less liquid and more complex. They are typically used by institutional investors or high-net-worth individuals seeking additional diversification. As markets evolve, alternative assets continue to grow in importance. Understanding asset classes changes how you think about investing. Instead of choosing individual investments randomly, you begin thinking in systems. Professional investors start by deciding how much capital belongs in each asset class. Only then do they choose specific investments. This approach focuses on portfolio architecture first and individual assets second. And interestingly, many studies suggest that asset allocation explains a large portion of long-term portfolio performance. In other words, the structure of the portfolio often matters more than the individual picks. Another key concept investors consider is correlation. Correlation describes how different assets move relative to each other. If two assets tend to rise and fall together, they are highly correlated. If they behave differently, correlation is low. Low correlation is powerful. It means one asset may offset losses in another. By combining assets with different behaviors, investors create portfolios that are more resilient across economic cycles. Diversification works because asset classes respond differently to the world around them. Different asset classes tend to perform better during different phases of the economic cycle. Stocks often thrive during periods of economic expansion. Bonds may perform well when interest rates fall. Commodities can surge during inflationary environments. And cash becomes valuable during periods of uncertainty. This is why experienced investors design portfolios not just for today, but for multiple possible futures. A diversified portfolio is essentially a strategy for navigating uncertainty. Asset classes are also the foundation of risk management. Instead of trying to predict markets perfectly, investors distribute risk across multiple sources of return. Some assets provide growth, others provide income, others act as protection during volatility. When combined carefully, these roles create balance. The goal is not to eliminate risk entirely. The goal is to design a portfolio that can survive risk. Large institutions like pension funds and university endowments rely heavily on asset class diversification. Their portfolios often include equities, bonds, real estate, commodities, and alternative investments. Each allocation is carefully calculated to support long-term objectives. These institutions aren't trying to chase short-term market moves. They're designing systems meant to perform across decades. And while individual investors operate on smaller scales, the underlying principles remain exactly the same. For individual investors, understanding asset classes changes the entire approach to investing. Instead of asking, "What stock should I buy?" The better question becomes, how should my capital be distributed across asset classes? Once the structure is clear, selecting specific investments becomes far easier. Portfolio construction moves from guesswork to system design, and that shift from picking assets to designing systems is where long-term investing begins to make sense. At this point, you can see why wealth building is rarely about a single investment. It's about architecture. Different asset classes play different roles. Some grow capital, some preserve it, some provide income. When combined strategically, they form a system designed to evolve through time. And once investors start thinking in systems, the conversation shifts from speculation to strategy. Understanding asset classes is the foundation of diversified investing, but knowing the categories is only the first step. The real question investors face next is far more strategic. How much of your portfolio should belong to each asset class? In the next episode, we'll explore one of the most important concepts in investing: asset allocation. Because the way capital is distributed across asset classes may be the single most powerful driver of long-term portfolio performance. And once you understand allocation, you begin to see investing not as a collection of assets, but as a carefully engineered financial system.